All right. So I don't know how much some of you are following the news right now, but before the COVID-19 outbreak, there was some tension between Russia and OPEC and the oil producing cartel out of the Middle East, and it led to sort of a price war. So there was this complex dynamics where OPEC wanted its members to keep the price up, and Russia, which has its own supplies, didn't really agree with this, and so OPEC then retaliated and ended up dumping a bunch of oil onto the market, causing the price of oil to crash. And this was an attempt to get Russia to play ball. And these types of dynamics are exactly the types of dynamics that we are going to be talking about today. It's like, how do we model these types of things? And then actually we'll sort of see the models from this chapter are kind of, at the beginning of OPEC and when Russia started to get involved. And so then we can kind of project ahead to even, so the reason I bring this up is today there were some additional drama, and as it looks like things might start to hopefully get resolved eventually between Russia and OPEC. And so so it just so happens that this lecture may actually be relevant to news that's even coming out today. So let's get on with it then. So the question here is, how do we model the dynamics of an entire industry? So we're going to be focusing on an oil industry, but this could apply to other things as well. So if you are thinking about modeling any sort of giant industry in your final projects, then this could maybe be a template for how to do that. Because if you think about it, when I'm talking about modeling an entire industry, we've got thousands of firms that are participating, billions of consumers. And the question is, do we really need to model all of those independently? So do we need just an immensely large model with a dense web of interactions? And we know with like our SIR models and with our models of innovation diffusion with the BAS model, then we found ways to kind of clump things together. So we didn't have to model everybody, but we could still model kind of everybody's aggregate behavior or their aggregate impact on each other. And so that's kind of what we're gonna want to look for here, is to try to adopt a modeling perspective that ends up making this modeling tractable and still ends up being useful and insightful. So instead of modeling individual firms, then the approach that we take here in the chapter is to model large groups of firms. Now, before we get ahead of ourselves, then we could say, well, why do we even want to bother with this? And so the example I like in this chapter is nice because this is actually taken from Morecroft's own experience. So the author's experiments of the textbook, he actually worked with Shell Oil, it was a Royal Dutch Shell at that time, and where they asked him to build the model that he explores in this. And so the idea here is the decision makers at Shell were interested in becoming more agile and recognizing industry trends and defining emerging business problems, and then teaching senior managers how to deal with such problems. And so the goal here was not to build models to predict the future. So they weren't going to sort of say, like, can you build us a statistical model which will say, based on historical trends, what is going to happen next? But it was more of, can we build a model that could help provide an explanatory framework for what we know about the oil industry, and then use that model to test scenarios for all the different things that might happen in the future, so that we can maybe plan for each one of those scenarios as a decision maker. So it's this kind of what if thinking. That really goes behind all of model building, is this what if thinking. So testing alternative futures, what if this happened, what would we do in response, and would our response even make any difference? So as an example of that, so these are real data from when oil became a market up till close to today, or at least when the textbook was published. And so you see here on the y-axis, you've got the price of oil in dollars per barrel. And you see that on the x-axis, you've got years. And so you see that as oil initially is very volatile in price. And so So we're going to zoom in here and we're going to focus on these different regions. And so at the beginning of the industry, we had a lot of volatility. And then suddenly this guy, John Rockefeller, gets involved, and he has Standard Oil, which is, maybe you've heard of Standard Oil. And Rockefeller was a businessman and recognized that in order to really run a business well, you needed predictability. So although sometimes it's nice to have oil prices that are high, it's not nice to know that you can't depend on those oil high prices being high. And so Rockefeller realized that if he could buy up enough oil and control the price of oil, then not only is he controlling a price, which has its own benefits, but by keeping it stable, then they can plan for the future. And so, this volatility sort of disappears because Rockefeller has figured out a way to control the price of oil. And then after Rockefeller, there are these so-called seven sisters. So these seven oil companies that you read about in the chapter that kind of get even better at this. And they sort of follow Rockefeller's lead and try to keep this relatively stable oil price that they all can plan for. And then we get into this region where OPEC gets involved. And so these are a cartel of countries in the Arabian Peninsula that have a huge stock of oil that also have political agendas that go beyond the kind of business agendas that maybe Rockefeller and the Seven Sisters had. And so they realized that because so much of the world economy has been devoted to oil, that they can capitalize on this and maybe achieve political outcomes by controlling the oil. So at that point, it's not actually important to keep a stable oil price, because that's not really, they are getting income from that oil, but they also want to exert control and pressure on the rest of the world. And so with that, you see that oil price is kind of liberated from this stable equilibrium here and starts regaining the volatility that you saw initially. And so you get some areas where things look like they're kind of back to normal. And during these times, because it kind of looked so similar to historical trends, experts during these times thought that oil price was going to stay low for the foreseeable future. And then, of course, the foreseeable future happened, and turns out they didn't stay low. And so it's clear here that there's really interesting dynamics going on. And if we just depend on our own kind of conceptual mental models, we don't really have a framework to really predict all of the different wild swings and dynamics we can get out of here. And so that's what we're trying to build, is a system dynamics model to help explain these patterns in the behavior over time, so that we're not sort of surprised by them, or if we see things starting to happen, we might be able to predict that if this starts to happen, then this is a bunch of things that possibly could happen afterwards, and we know kind of how to prepare for that. So with that, so how many of you, well, I guess I'd say, so some of you may have taken a microeconomics course, either as an elective, or maybe you've taken SOS 325. And so when we talk about how price, what are sort of, so you can just answer in the chat or you can answer verbally, what are sort of two words that frequently come up when we talk about price being set in a market? Does anybody have a good answer for that?
Supply and demand.
Supply and demand, I heard that pop up there. So yes, supply and demand is how we usually think about how price is being set. In fact, in microeconomics, you could say, what drives a change in price? Well, if there is a gap between supply and demand, meaning that I'm providing more than the market wants, so that would imply that the market is going to pay less than I would prefer them to pay. And so that might mean that, that I have to set the price low. But if I'm also providing less than the market wants, then, or less, sorry, then if I'm providing too little, then the market is going to want more than that, and I am going to be able to get away with raising the price above where it currently is. So if there is a gap between supply and demand, what I am able to supply and what the market is willing to demand, then that gap suggests that we could change the price. And as we change the price, it's going to change the quantity demanded from the market or the quantity supplied from the producer. And we can model, those gaps using dynamic hypotheses that we've seen before. So, so here's another question then out for you, is that have we seen a system archetype that involves gaps and how those gaps change behavior in a regulatory way over time? What's like a basic system archetype that we've seen that looks that way, or that involves gaps? Anybody? You can also put your answer in the chat if you prefer. I see drifting. So so that's interesting, because that does, I think we could, that's kind of getting more complicated than I need. Like the drifting is like, once we've got even more loops and all that, if you get even more basic than that, like if I see the word gap, and I want to draw a causal loop diagram, what's like the basic causal loop diagram that I might draw? It might be just a single loop. And if you think about it, like, think about your toilet, like after you flush the toilet, balancing with delay. That's kind of what I'm looking for here. If you think about your toilet example there, after you flush a toilet, there's a huge gap in the toilet. So there's the desired water level, and there's where the water actually is. And it's that gap that causes the water to eventually raise up until it closes that gap. And then at the point where it closes the gap, the action shuts off. And so that is a balancing loop. And so this is the kind of causal loop diagram that you can then imagine, that if you have a narrative which says, I am seeing a behavior being driven by gaps, where the behavior ends up closing those gaps over time, that suggests go back to thinking about your conceptual model of how a toilet works. And then you say, aha, I'm going to take that model and I'm just going to change the words around. And then that will become my basic model for what might be driving, say, price in a market. So this is our basic dynamic hypothesis here. And the thought was that, well, I've got a supply of oil up here in the top, and I've got a demand for oil, which is out here. And if there is a gap between how much I'm willing to sell and how much people are willing to buy, then depending on whether that gap is positive or negative, then that is going to affect the oil price. And if that oil price raises up, then that's going to encourage investment. And with investment, that is going to encourage a further increase in the supply of oil. The other way around is if the gap is such that there is too much supply or too little demand, then the oil price is going to reduce, which is going to reduce investment in new oil, which after time is going to reduce the supply of oil. And so this balancing with delay, that actually seems to make sense for explaining potential oscillations that we could see in the market. So we think that, okay, this might explain some of the volatility that we see in the oil diagram. So in the oil behavior over time, maybe we can just model it as a balancing feedback with delay. But then when we look back at that diagram, we see that there are long regions of stability. It's not all this like oscillating volatility. And so, and pardon me, I'm just going to shut my door. My wife is teaching at the same time, and I think we might be cross-talking. And so these, so the question is, how do we deal with these long regions of stability? And so so after they came up with this basic model at Shell, and they realized that, that this didn't explain the entire graph, then they broke into groups. And the team identified that they need to have a much more complicated model. And as when you build these complicated models, it's going to be much simpler if you can find large sectors. And then once you've identified your sectors, then you can develop that. That's something I'm trying to get you to practice in assignment E5. We've got these 2 sectors, and you can develop each sector independently and then link them together. So then the question is, what 5 sectors do we need for this? And they identified these 5 potential sectors here that we're going to then focus on and see how they model those. So if we zoom in on just these 2 sectors on the right here, then this is the traditional market of independent producers and oil consumers. So we're not worried about OPEC. This is kind of the laissez-faire economics. This is just, if everything's just driven by the market, if it's just the invisible hand setting the price, then that's what we got here. We got independents. So they're not a cartel, they're not working together, they're just independent oil companies. And there is a market of consumers. And this market of consumers interacts with the independents, and that's what sets the price based on supply and demand. So that basically we can model with this balancing feedback loop with a delay. So if you didn't have any of the OPEC stuff, then maybe you just would get something that has these oscillations, and we could end up modeling it like this. But then you realize that, how do we explain all of the other interesting dynamics? Well, then let's focus on these other three sectors that involve OPEC. So these are the Organization of Petroleum Exporting Countries, OPEC. So a group of countries in the Arabian Peninsula that has access to a huge amount of oil. And they have so much access to oil that they have the ability to move the market independently. So by collaborating with each other, they can control the market. Whereas the independents don't collaborate, and they also don't have access to enough oil to be able to actually make a dent on the market, even if they did collaborate. So this is explicit control over the market based on political and social pressures. And so we need to somehow model that in these three sectors. So we're going to drill down into these sectors here. So let's look at this quota setting sector here. So basically OPEC meets periodically, this cartel, and they then look at the commercial market and they set quotas. So basically quotas are a way for them to say how much each member of OPEC produces. And so by establishing these quotas, they can control their own oil revenue. So if you've got these individuals that all agree that they're going to put this much out into the market, and they are then dynamically going to pull oil out of the market and put oil in. If they're dumping enough oil in and out of the market, then they're basically determining the price of the market. The same way the Federal Reserve is able to buy and sell in order to change interest rates. So it's a similar sort of idea. You have enough of a buffer that if you can dump enough of that buffer on and off, then you can kind of buffer against the actions of anybody outside your group. And so this is that one sector that is sort of where everything happens. But so that's where the decision making is made. So we're going to eventually drill down into that and see that. But then how do they actually make it work? Well, there they have this thing called a swing producer. Now this is one country, in this case, Saudi Arabia, and they're the ones that really has the most oil in OPEC. And so they're the ones that is probably going to benefit the most, but they also are going to be the ones that is really the lever that OPEC uses to control the market. And so they have so much oil that they can dump it onto the market and cause the price to go down, or they can stop providing it, and suddenly the price, there'll be a shortage and the price will go way up. And so this is our so-called swing producer. And so they're going to take as an input the quota that was determined. They're going to take that oil price that comes in, and that's how they'll end up deciding how much oil they're going to produce on the market. Now, the rest of OPEC, so they provide a fast-acting feedback to be able to control that price. They are a regulating feedback in order to sort of make the oil price whatever they decide the oil price should be. So then the other half of OPEC are the opportunists. So these are the other countries there, and they have quotas that are set as well because they do have access to a lot of oil, and they produce some. So you have to keep the opportunists in line. So the swing producer has to not only control the rest of the market, but there is a chance that these opportunists are going to cheat. And they can overproduce to increase their short-term market share. So let's say the price is, and I see the question here, and I'll answer that just in a second. So if the opportunists see that the price is set really high, there will be a temptation for them to produce more oil than they were told to produce, so that in the short term, they can sell it for the high price. But then over time, the extra oil that they're putting onto the market is going to reduce the price. And so the group as a whole wants them to not cheat. But if any one individual produces a little bit more, then that individual will benefit so long as the rest aren't also overproducing. So we have to somehow control these ones. So the question here was, is a swing producer always a company, corporation, entity? So in the case of OPEC, the swing producer is Saudi Arabia. So you can think of it as one country that has control over this giant resource that they can dump onto the market or pull out of the market. So in any sort of cartel that controls a market, you're going to have some way to have a fast acting feedback where you can penalize the market for not doing what you want it to do and effectively have control over it. It just so happens in OPEC, there's one country that is the swing producer that allows them to do that. And you might argue that if there wasn't enough oil in one country to do it, if you had to kind of coordinate among a bunch of countries, then you would have this temptation issue, and you basically couldn't get them to coordinate enough to make this happen. So it's almost like you need a level of centralization there. So for this chapter, when I say swing producer, just think of one country, just think of it as being Saudi Arabia. All right. So, so those are our 5 sectors. And so we're going to drill down and see how to actually build the model for each of these sectors. But we could have, if we were studying different aspects of this problem, we might have chosen different sectors. And so we didn't really care about drilling down into these independents over here, for example. It was enough just to know there are some independents out there. But if we wanted to model these kind of nuanced aspects of what's going on inside, say, the United States oil market, then we might need to then have a more higher resolution model of what's going on here. And maybe OPEC, we could bundle up into one sector. And so just here, because they were kind of zoomed out and looking at the world and interested in knowing how this cartel affects world prices, these are the sectors that they drew. So it's not always clear what the right choices are. You just have to guide them based on the questions that you're asking and how informative you think these variables would be in answering those questions. So with that in mind, are there any questions about the high level outline of these 5 sectors that we are now going to drill down into to see how to build? All right, I see if the petrodollar global oil being traded with the US dollar as an economic baseline were a variable, how would it be included into the systems chart? So we could, if we were worried about, there's all sorts of things that we could add, you know, exchange rates and other things like that. You could imagine adding to this, and you could imagine maybe complexifying the market down here, for example. And so there are those complications, you know, would probably be added within this kind of the market, or maybe within independence here. Or maybe they need a whole new sector, which kind of modulates how oil is exchanged between countries. So exactly how to do that, there's probably multiple different ways. I would initially guess that concern would be investigated inside this sector down here. Exchange rates and those things considered converters. I would say that if you wanted to do an exchange rate, and a converter would make a lot of sense, or if it's a simple function. So if you know that the exchange rate isn't going to change over time, if it's always that 1.5 euros is $1, then you could just use a mathematical formula for that. So you could just create a variable that takes dollars in and has euros come out. But if you want to make it so that the exchange rate is changing over time, so like as you get more dollars in the market, then the exchange rate for dollars changes, then a converter would be one way to do that. You could kind of draw out a graph of how the number of dollars in the market changes the exchange rate for dollars. And, you know, or you could maybe implement that as a formula. Your question of whether to use a converter or not is really whether you can come up with a mathematical expression, or if you can only draw a graph. If you can only really draw a graph to sort of give you the kind of qualitative features of it, then you have to kind of implement that as a converter. But whenever possible, it's kind of better to write a mathematical formula if you can. Any other questions? Appreciate those interactions, it's great. And also, I know it seems like we've got enough bandwidth. If you guys are feeling sort of socially isolated and you'd like to turn on your cameras to see each other, and you can click on the little gallery view, you know, that's fine. But you know, you don't have to either. But I just want to put that out there. If you're feeling like you'd like to see each other, feel free to turn on your cameras. All right. So now let's focus in on independence and you know, the right-hand side here. And so this is basically going to be our balancing feedback loop with delay. So let's see what the components of that are going to be. So if we zoom in on the independence, and then we're going to further zoom in on this kind of, on this coordinating network here, then if we think about what do we need to determine the independence capacity, so how much oil they can put together there, then we kind of need to know things like what's the tax rate. There's this thing called a hurdle rate. And so this is basically what makes it, how much benefit do I need to get out of producing oil for it to be worth it enough? So there's a certain risk in getting involved in investing in capacity to produce oil. And if your expected return is under the hurdle rate, then maybe you back out completely and stop investing in capacity. How much it costs to develop is in there. The oil price, the current oil price, but then you might also need to build a model, and this could be a converter or some statistical model might say, if I know the oil price today, maybe I actually want to try to predict in a year what the oil price will be, because I know that it's going to take a year for me to develop my capacity. So maybe the current oil price isn't enough. I need to use the current oil price with a model to figure out what the future oil price will be, and that will be how I decide on my investment. And then there's this social or this psychological aspect of optimism. So I think, you know, if you watch market, you know, variations right now during COVID, for example, a lot of the variations you see in a market are, I mean, some of them are determined by these measurable things, but the rest of it just kind of, you know, is determined by people's psychology. How optimistic do they feel? And so you might need to build in a parameter that says that, you know, under these conditions, we are only going to make an investment choice if we're optimistic, or under these conditions, we're not going to make an investment choice if we're pessimistic. And so you might need a parameter to model the psychological aspects of optimism. So then if we can, then you say, well, then how do we put all that stuff together in a coordinating network? And we then, in the book, they build this coordinating network here. And you see that although in the kind of high level, we just had a single stock called independence capacity, we see that in order for us to really model what's going on there, we actually need several stocks. And so we need to know like capacity and construction, you know, and we need this giant, you know, reserve here. And so we can kind of zoom in and see there's a bunch of options here that we kind of need to ask domain experts for. So we don't know what so CapEx is short for how much capacity. So CapEx is your expansion optimism. So you know, how much capacity, what is our optimism in expanding our capacity? So we, you know, that's set here as a slider, and exactly the value that you set on that slider, you need to ask an expert for. The hurdle rate, we need to ask an expert. We need to go out to the market and say, what is your hurdle rate? Expected future oil price. We don't have a model for that. We need to go out and ask an expert. How are you predicting what the future oil price is going to be? And so we can provide some of these opinions as lookup tables. And so you'll notice that there are a number of lookup tables. Those are the things with the kind of tildes, the little curly things on here. And so when we ask these down here, there's some other lookup tables as well. So when we go out and we look for domain information or historical patterns, we might not have a mathematical model for that. And so we just put them in as a lookup table. And then, so yeah, there's a question about sliders. And so, yeah, we did talk about sliders in lecture E2, and there is a video underneath lecture E2 in the Unit E module talking about sliders. If you're using Vensim, the quick note that I'll mention to you about sliders is if you click the sim button, which is right next to the run button, it will run the simulation, but it'll turn all of your constants into sliders. And it will put little, let me see if I right click here, and it will put little thumbnails of the behavior over time inside each stock or inside each dynamic variable, so that you can see a rough picture of what those are doing as you're moving your sliders around. And so you'll immediately move the slider, and then you'll see these things change. And when they change in an interesting way, then you can click on one of them and then click on the graph button inside Vensim, and it'll then expand that graph and give you a full graph. So in Vensim, that's how you can work with sliders, as a reminder. In Insight Maker, then you, on the right-hand side of Insight Maker, so over here in Insight Maker, when you click on any variable, there is an option to turn parameters in that variable into a slider. And then when you click away from that variable, then you'll see all of the sliders there on the right-hand side panel. And you can then use those sliders and move them around. But then after you set the sliders, you have to hit run, and it'll show you an output with those sliders being set. And then you can move the sliders to a different value and hit run, and it'll show you another one next to it. So I think I covered both of those things and some more advanced options in the video that's underneath the Lecture E2 video. That's kind of a nutshell. And if you have any other troubles with that, then feel free to email me or come to office hours or make an appointment, and we can go over sliders in more detail. All right, so lookup tables we can often use to quantify these expert opinions. Okay, so let me clear some of this red out here. Well, maybe I'll just move on to the next slide. So, okay, so now how do we build the dynamics in here? So we've got, I said that we're going to have this balancing feedback loop with delay. And so if I go down and think about the market here, then I've got this demand for oil, which I can actually model itself as a stock, and I can have the model oil price as a stock. I choose to make them stocks because they can potentially change over time. So this demand for oil in this simple model is modeled as like a constant coming in, but we know that the demand for oil in the kind of big model might change over time. And so I'm modeling it as a stock, and its flow coming into it, in this change in demand, is going to be set by the effect of the global economy and the environment. So this will provide an opportunity for the demand to change over time. And so sometimes there'll be more demand and less demand. Now, regardless of what the demand is, then I've got my market oil price, which is affected by not only the demand, which could be a constant or it could be changing over time, but also the total amount of production. And so you can imagine this being the sum of how much oil is coming out of the independent producers as well as OPEC. And so you dump all of that production into a model, which basically is just going to take the difference between the demand, the current quantity demanded, and the current quantity supplied. And it'll use that gap between these two to determine how to change the price. And so if this gap is positive, it'll move the price in one direction. If this gap is negative, it'll move the price in another direction, and that will change this price. And then the price can then potentially feed back into the demand. So as people see that the price changes, then it's going to affect the amount of the oil that they demand. So the quantity demanded. So you can think of this as a quantity. I'm going to do QD, quantity demanded, and you can think of this as quantity supplied. So I'm going to write a QS. And so this helps model this feedback loop that's over here. And you can add in these additional terms here for realism, like this effect of the global economy. So that's basically how we model the easy side of the diagram, the kind of independent producers side. We basically have two sectors, and so I'm going to go back and look at the other sector. So we've got this independent sector, which is, we've got a price of oil coming in. So if I were to write price here, that is coming in as, and it's not shown here, but then it may affect the expected future oil price. So that's how it is going to connect to the sector beneath it. And then that is going to go through this whole coordinating network This is modeling how they decide how much extra capacity to build. And so they then initiate new capacity, they construct new capacity, that ends up creating new capacity. And with that new capacity, then up here, they produce oil. And so that oil, combined with OPEC's oil, then gets shuttled down into the bottom loop, which is kind of the market for oil. And so this total production down here is going to be that independent production plus the OPEC's production, which we have to model next. And that total production combined with the demand for oil is what sets the price of oil. And so we had to model that as a stock, which allowed our price to change over time. As the price kept changing, then the quantity demanded kept changing, and that ends up being our balancing loop over here. So that's the basics of just the market for oil, the independent market, and the independent market and the price setting part of the market. So before we move over to OPEC, are there any questions about that? Just modeling the basic market of the independents and the consumers before we get into the price setting controls that come from OPEC.
I have a question.
Yeah.
In my group project, we're doing a bit of like marketing and consumption. So I know that you said to make the model more realistic, we can add some more arrows on the side. Right here it says effect of the global economy and the environment goes into change in demand. Can we add variables like that?
Yeah, absolutely. So like if the pure microeconomics would like not have this thing here, they would just sort of say that based on whatever the price signal is, then that would change the quantity demanded. But the relationship between the price signal and the quantity demanded may be affected by other factors. And you, if you'd like to, can then model those other factors. So it might be that, that let's say, I'll use a heating case there. So there's demand response is the idea that if you give me access to the price of energy, then it may affect how I set my thermostat. And so based on the price, then I might choose whether to set my thermostat to cool more or to make it a little hotter in the house. Now, my relationship between price and how hot I'm willing to tolerate it may be set by other things that are going on in the global economy. So if I have a lot of money to spend, so if I'm doing really well, the economy is going great, then I might be willing to waste that money and just keep my house as cool as possible, regardless of what the price is. But if there's a lot of other things that are affecting my pocketbook, affecting how much money I have available, then maybe I am very responsive to the price. And so those types of things could be modeled inside here.
And for each of those things, so we would have to come up with the equation
or a lookup table, some way to capture the idea that I mean, so I would start without those and say, imagine that everybody's mental behavior is constant. How would they respond to price signals, and try to get that working? And then you could say, okay, now how could we change the psychology based on some other variables that are in our model? And then you could then introduce those. So I would do that in layers. Does that help?
Yes, thank you.
Mm-hmm. So any other questions about this? I know many of you might be thinking about having some sort of market or price signals in some of your models. And this is how you might do that. Okay. All right, so let's look at OPEC. That's when things are starting to get even more interesting. So first thing we want to do is model the swing producer. Remember, the swing producer in our example is Saudi Arabia. And so the swing producer has got two different modes of behavior that they need to be able to switch between. So in our model, we're basically going to have some variable which basically tells the swing producer whether it needs to be in a production mode, like a swing mode, where it's just trying to control the price, or a punitive mode, a punishing mode, where it detects that one of the members of the cartel is not behaving, and it actually needs to punish that member of the cartel. I mentioned to you that just before COVID, the OPEC decided to tank the oil market in order to punish Russia. Russia is not in OPEC, but they produce enough oil that they kind of have to be aware of OPEC and vice versa. And so they try to control each other. And so just before COVID, it was kind of buried in the headlines because COVID came up, but the swing producers, or OPEC just in general, launched themselves into punitive mode, not to punish people inside OPEC, but to punish Russia. And so we're seeing kind of an example of that. But imagine here, we're really just focused on them punishing the members of OPEC, because those are the ones setting the price. So when they're not in punishing mode, then they basically take the market oil price in, and they take whatever their decided intended price in is, and then they measure the difference between these two. And based on the difference between these two, then they can choose whether to put more or less oil into the market. So, and the swing producers got their own quota that's been decided ahead of time. So basically, you start out, and it's been decided you put so many million barrels of oil on the market in some unit of time. And then that's where you kind of start. That's like the feed forward signal to sort of say like where we're going to bias the system. And then they can perturb off of that based on price signals. And so if the intended price is currently, let's say they want the price to be higher than it is, then so the market oil price might be lower than they want it to be, then that means that they are going to reduce the amount of oil that they are producing. And so that's how these two price signals go into the flow here, which affect their oil production, which allow the whole market to kind of move around. Now that's what they're doing normally, but occasionally they will detect that one of their members is violating their quota. They're not producing what has been agreed upon. And then they switch into this punitive or punishing mode. And so still we've got the market oil price coming in, but they have a different price, a punitive price. And they basically have said, okay, if our cartel members are not fulfilling their quota obligations, they're trying to cheat and overproduce a little bit to benefit more than we've agreed upon for them to benefit, then we are going to drop the price of oil in the market to a much lower price, a punitive price. So we're going to punish them. It's going to hurt us. It's sort of an altruistic punishment. So the swing producer is going to make less money from this, but they are going to get their cartel members in line. And so in the long run, it's going to benefit the swing producer and hopefully the cartel as well. And so they have in that an estimated market share and a minimum threshold for the market share. So these sort of things go in to kind of tell them when to swing in and out of this this punitive mode, and so then hopefully that will then bring the cartel producers back and allow them to switch back to a different mode. So can I pause for just a second and let's think if you have questions. I think I may need to move my dog because he's barking right now. So I apologize for that, but just give me 1 second to move him, and then we'll be right back and we'll start talking about quota setting. So we're good.
All right, sorry about that.
Okay. So hoping everybody can still hear me. So any questions about the swing producer having these two modes that it has to switch between?
Just a random question.
Mm-hmm.
Next time, can you show us your dog?
Sure. I can. We can do that. Yeah, he's downstairs right now, but next time I'll show you him. Agreed. I gotcha. All right. Okay. So quota. So now we have to sort of model. We've modeled what happens when they violate quota, but how do we set the quotas? And so we go down, and so we have another stock. Anything that changes dynamically, anything that can hold a value for a long time and then change, you're going to want to make a stock in your models. And so quotas are one of these dynamic variables that they can hold a value, but then as things change, they can move around. And so we need to make them a stock or a state variable. So the quota becomes a stock. And so then we need to say, how does this stock change? And so we have some quota bias, which is just kind of a constant. This is kind of like optimism. You can think of it like that. And then you have a global oil demand. So this is how much oil is currently being asked for by the market. And then we have how much oil is being produced by everyone outside of the cartel. And then that then allows them to say how much is left over for the cartel to produce. And so they then look at how much is left over, and then they kind of look at their bias on how much they want to be producing, how much they want to be producing in the market. And then they use that to change their quotas. And so there's a model for how to bring all these things together that's fit to how people model how the cartel has worked in the past. And that's how they set this agreed upon quota. And so that allows for driving these market prices up and down, this quota. And then we've got negotiation inside the cartel. And so we've got how much the swing producer can manage to swing. And that goes into how much capacity the opportunists have. And so this is how much oil they all can kind of control. And then that goes into a formula which will represent how they can negotiate these quotas. And so they together want to produce this much oil. And so if you look at how much the opportunists can provide relative to how much the whole group can provide, then, and you have how much the quota can provide, then you can say, well, based on how much we want to produce, this is basically saying what fraction of that comes out of the swing producer and comes out of everybody else. And so if you make the swing producer do everything, then the rest of the countries don't benefit because they have to sell their oil to make a benefit. But if you depend on everyone else to do it, then you don't have the fast acting feedback from the swing producer. So the swing producer has to have the ability to act quickly, which means they have to be producing most of the oil, but you have to allow the opportunist to produce some oil because they want to make money off that oil too. And so that balance between how much you have in the swing producer and how much you have in the opportunist, it gets modeled in formulas that you'd put inside this variable here for quota negotiation and allocation. So, and you can imagine different ways that you can do that. And you can also imagine different ways that you can model compliance. And so this is where we go into how the opportunists behave. And so you basically can have, well, all right, how do we model when the opportunists are in line and when they're not? And so what Morecroft did is he created this lookup table that models this surplus utilization based on a price gap. And so this is a price gap between the market, this is supposed to be markets, not marker, but I think the intended market price and the oil price. And we use that for the apparent cohesion of the cartel. And so if there is a very large price gap between the current market price and the oil price, then there will be what this is modeling here is that the surplus utilization will be down here at 0. And so and I think I had surplus utilization modeled somewhere. I thought I showed where that actually pops up here. Well, so the opportunist change in capacity is what is in the this opportunist production is where that lookup table ends up showing up, because you have this intended price and the oil price goes in, and then the opportunists look at how much they're currently producing. And they can say, based on this lookup table, this sort of represents how tempting it will be in order for them to overproduce or produce on schedule. And so you can kind of come up with these lookup tables which represent the kind of temptation to defect. And that's kind of what Morecroft was trying to model here. And he didn't necessarily have any good data for representing how tempting it was, but he just kind of came up with a basic function to sort of say that if you're right at the intended price, so you have the intended oil price and the market oil price, then maybe you have zero surplus utilization, so there's no defection. But maybe if you're right at it, then maybe you're not. So I guess the question here, and I guess I should myself review how he implemented these things, but without me getting into details that I'm likely to screw up here, if we were to go back and to look back at the textbook, then this is all this curve is trying to represent is that under certain market conditions, it will be when you're right at the intended market price, you'll have one level of temptation. But when you're not at the market price, you'll have a different level of temptation. And it is, to my recollection, when you're at the market price, then it is very tempting to overproduce a little bit because no one's going to notice and you can benefit more than everyone else. But if you're well below the market price, you better stay on quota, because if you're well below the market price, if you overproduce, you're just going to make the problem worse. So as you get closer and closer to the intended market price, there's more temptation to overproduce. But as you get under, farther and farther from the market price, when you're under the market price, you don't want to overproduce and you kind of let the swing producer pull oil off. So that's how we're modeling the kind of psychology of the members of the cartel. So, so before we add the last complicating factor, are there any questions on how we've modeled OPEC? So we've modeled the independents, we've modeled the market, and we've modeled OPEC. So we need to add one more element to it that actually relates again to current events. But so are there any questions then about how these OPEC loops work? If anyone's interested, he's a Cocker Spaniel Bichon mix. He's kind of like a cocker, but he's as long as a Bichon. And so he's like, has the proportions of a wiener dog and all the back problems of a wiener dog. And that's why we have to carry him around from upstairs to downstairs, because he can't go up. His name is Fritz, F-R-I-T-Z. So he's a little black and white dog, very curly, hypoallergenic hair.
He's allergic to himself?
Pardon me?
Is he allergic to himself?
No, he is. He's not. Nobody's allergic. No one's allergic to him. That's the beauty about his hair. He's got like poodle hair, So it's so that's what I mean by hypoallergenic. Doesn't shed. Yeah.
Oh, cool. I don't have any questions about this model just because I'm confused in this class. But if someone does have questions, you should say it, because I probably have the same questions and don't know it.
Thanks for that. Yeah, we're almost done here, so the hope is that I will have some time to meet with groups. All right, so with that in mind, let's then close out this model. And again, this is at this point, all the remaining lectures are basically supposed to be examples of models of complexity that might go, yeah, you can ask a question just in the second year, but these models are just meant to be examples of things of similar complexity or slightly greater complexity that I'm expecting to see on your final project. So if you'd like, you can even take these models out of the book and use them as templates. If you like certain aspects of them, you can borrow those and kind of build those into your models. So yeah, Emily, you had a question from the assessment. Confused about the difference between the quota setter and the swing producer. So do you have a specific question, or is that your question? Just like, what's the difference between quota setting and swing producing? All right, off the top of my head, I don't remember the exact wording of the last question on the quiz, but I can go back and look at that and then respond to that here after we get out of the presentation. But basically, quota. So the swing production is you're not actually, that's kind of after you've agreed on a quota and you're dumping oil on the market to then which is might go slightly above your quota in order to move the price around, versus the quota setting, which is where you actually get all the producers together and you decide on how much you're nominally going to produce. Oh, great. So you have the question pulled up.
Yes, it says, what is the name that Morecroft uses to describe the role of the player in OPEC that has enough oil capacity surplus to tightly control the global price of oil?
Gotcha. So that is what I call a swing producer. And so that is this that is the one party that can respond fast and with enough control authority that they can drive the price of the market. And so that's so swing producer was what I was looking for there. Okay, great. All right, so the last thing that I want to add in here, which again is very relevant because again, as of today, there's news about the fight between Russian oil production and OPEC oil production. But at the time this model was produced, Russia was not a big player. But then the question was, what were we going to do about it? Because Russia, so think of it as they can swing prices of the market. Yeah, you can think of they can very quickly, yeah, you can think of that as like, they have so much inertia. They're like a big massive object that can swing the whole market with it. And so it's kind of like if you were a train or something like that, and the last car was really, really massive, and if it could somehow move or whatever, it would drag the whole train with it. So they can swing everything, where anybody else, any one producer, if they dumped a little bit more oil on the market, the market wouldn't change, and they'd actually probably be penalized. Like they wouldn't actually want to dump more oil on the market because they wouldn't be able to get enough back from it. But the swing producer can dump so much oil in the market, they can change the market. All right, so at the time when this was coming up, the USSR was breaking down, and then Russia was coming into play. And Russia, which used to have just keep the oil within the USSR, was now exporting oil to the rest of the world. And so Russia was now potentially a player, but nobody really trusted Russian oil at that time. And so then the question was, how were they going to deal with these undeveloped reserves that were coming from this new Russian player? And so what they did is they added to the model these risky Russian reserves, another stock over here, which over time, so you could view this as like a smoothing delay. So notice, time to build trust in Russia. And then you've got the risky Russian reserves going into the flow. This is basically kind of like a smoothing delay, where you dump the Russian reserves into the market at some time, and they don't actually become available until sometime later. And so that's kind of implemented through this, which is basically a kind of smoothing delay. And then those secure Russian reserves, once they're secure, people kind of trust them, then they get adopted at another rate. And here's that time to agree. So these are all like time constants inside more of these smoothing delays. And then so eventually you get, now it might look more S-shaped. So this kind of like, whereas the initial thing was a steep rise, and then it kind of got a less steep rise, and now it's kind of an S-shaped rise. So I can maybe draw this as more S-shaped, because it's like the cascade of two smoothing delays. Then eventually you have these undeveloped reserves that are now available on the market. And so there's an extra delay in getting a Russian stuff to market, but it potentially can help, or it can at least affect the amount of oil on the market. So we put all of that thing in together, and we get this giant model, which has it has all of these different partners, a ton of feedback loops, and a lot of room for a lot of really cool complexity. But we built it in these kind of simple chunks and all these sectors that we could link all these sectors together. But after we tie all of it together and go into, you know, a Vensim, then we hit play and we get cool dynamics that look like this. And so we can actually hit play and without changing anything, see that we get large regions of stability followed by these regions of volatility. And that looks a lot like the graphs that we were originally expecting. And so we'd say, well, wow, what started these graphs here? And it turns out that if we look more closely at what's going on in this, then what we see is that, so there's this, so this is our oil price, and our oil price is gradually increasing over time. And then this too is demand minus production here. And you can see this is kind of getting a little bit lower over time. So there's a slight decrease here. And I tried to draw that at a decreased angle. Maybe I'll make it more emphasis. There's a slight decrease in this line here. And what happens is it crosses a threshold. And as it crosses that threshold, it causes the swing producer to then flip into punitive mode. And that punitive mode ends up causing the oil price to tank. And that's what's happening here, which leads to these oscillations in the market. If military action, I'm reading a question here, if military action to acquire oil resources were included in the model, where would it be included? And so that is, you have to sort of ask yourself, how would those military actions affect things? And, you know, would they gain control? They could say, well, let's say we take control of Saudi Arabia, you know, then that you might not need to simulate the military, but you might need to change the way the quotas are set, for example, because now if you take control of Saudi Arabia, or if through political channels, you then have more control of Saudi Arabia, that might change the equations for how quotas are set. So it just kind of depends on what aspect of that and what time scale that you want to simulate. So over long time scales, you may not even need to put the military in, you just change the dynamics. Over short time scales, then you can imagine military action might, you know, that might lead to the cartel bias changing, because they might see the impending military action and they might then make more oil available to maybe stave off the military, say, no, we don't want you to come in. Or they might reduce it. They might say, no, you better not bring your military in here, because then we're going to take oil away from you. So there's all of these different hypothetical ways that you can put this into that. And what you would do as a policymaker is try both. And you'd say, like, well, we're thinking about military action. What are the different things that could happen? And what are the probabilities that one thing will happen and the other thing will happen? And then we kind of use that to decide if we're going to do military action. So we should first start with the 5 sectors and make our model and build, I'm reading a question here, and build from there, depending on how those variables connect with each other. Then we add converters and outside variables to make it more realistic. Just trying to recap. Yes, start small, get something working, and then keep adding little complexifying things. So if you get your independent oil market working, that's great. Then you add OPEC, that's great. Then you add Russia, and then you put them all back in together. And that's kind of how we do our model building. So in this case, we sort of successfully at least generated scenarios in our simulated model that, even though they weren't data driven, so it's not like they were, like, you know, driven they still produced behaviors that look a bit like the behaviors that we see in the real system, which gives us some confidence that maybe we can gain insight by now we can use this model that we built to test scenarios that may be realistic representations of what might happen in the real world if we were to then see those scenarios unravel in the real world. So that's kind of a brief overview of what's going on there. So are there any questions then from that kind of overview of a model of this giant oil market from chapter 8? Okay.
So for chapter 8, if we're still kind of lost, do we just go back and read those parts that you suggested that were on the quiz, or just digest the whole chapter? Because it was a lot to take in.
Right. Yeah. There's a lot in the chapter, and I mean, it's kind of, I mean, I definitely would. So I like on the final exam, I'm not going to ask you a lot of very detailed things beyond kind of like I'm not going to ask you things like detailed questions about what's going on inside the model of the independent producers or something like that. It might be good to know that for this example, like what the basic 5 sectors were, but like all the details about how these formulas were formed, you don't need to sort of like memorize or anything like that. But I'm just hoping that chapter 8 becomes like a template for you to look for more information as you're looking for inspiration on how to build certain things in your own models.
So now that you mentioned the final exam, by any chance can you tell us how that's gonna be? Just because I know we're all gonna have final exams. Are we gonna have like a study guide or be able to like go through it like we did for our midterm, or?
It's exactly like your midterm. In fact, if you go to the final exam module on Canvas, there's already sample final exams from previous semesters and like a study guide there. So if you'd like to start working on that already, that's already there. And the format of the final will be very similar. It'll be a 75-minute final, but I'll probably make it a little bit longer. I will probably give you more time, but it'll be designed to be completed in 75 minutes, just to account for any technical problems that might, happen. But it's basically that it's going to be that I'm not going to change the final exam very much, because before it was going to be Scantron and now it'll be Canvas based. So I'll give you a little practice exam, like a 1-question exam, just to make sure everybody is familiar with Lockdown Browser. But then after that, it'll be nearly the same exam that I would have given as a Scantron. It'll be very similar in format to the midterm.
Okay, thank you.
And I think Zoom study groups are great. I'm also going to see if Taha's got availability that he might be able to set up study groups for you guys as well if you have questions that he could help with. Plenty of time until the final. So not to make you anxious about that, but just putting that out there. All right, so looking forward, we've got just 2 more chapters to cover, chapter 9 and chapter 10. In chapter 9, it's a long chapter, and so I'm saying you can skip the sections at the end that are about the medical workforce dynamics and patient care, as well as the appendix. And then there's chapter 10 as well. For the rest of the time we have here, which we end up going a little bit longer, we had some questions, but I'm happy to hang out and talk about the assignments. And then of course, I've also got office hours today. It's sort of special. I have office hours on Thursday. So I'll hang out in here until 4:30, and then I'll flip to my office hours room at 4:30. Looking forward, Tuesday is going to be another work in class day, but I'm expecting by the end of the class, you will have this, each group will have a demonstrated basic model. It's not your full model, but you at least need to show me that, look, we came up with these stocks and these flows, and they represent kind of an aspect of the problem we want to model. And then we hit play and it runs, and it even gives us results that kind of make sense, just to show me that you're sort of on the right track. And then here's the kind of the schedule for that. So go ahead.
Sorry. Could it basically be just how our sectors connect and try to just simulate by the equations that we make and things like that?
Yeah, like if you could say, like, we're going to try to build these 3 sectors, but we've only started working on this first sector, and here's our basic outline for what we think is in our first sector. And so it has these 3 stocks, and it has these this coordinating network. And when we set the variables up this way, just based on anecdotal evidence, when we set them to these values and hit play, we get a graph that kind of makes sense. And when we move the variable to this other thing, the graph changes in a way that kind of makes sense. So if you kind of show me that you're you're at the point where you can build models, then that's kind of where I want you to be. I just want to make sure that people aren't like in the last week before the project is due, still trying to figure out how to even get started. So you just kind of demonstrate to me that you're getting started. That's what I want to do on Tuesday.
Okay, and this is for more in the future, but for our final presentation when we're showing our model to the class, that's still happening, right?
That's right, but we won't be doing it synchronously, and this was the original plan anyway. You'll basically use Zoom with your project to record your presentation, kind of like we're doing with these lectures, and then you'll upload them to Canvas, and then you will then peer review one other project. So you'll, each individual student will then watch someone else's presentation and then provide a peer review.
Okay, thank you.
All right, any other questions? All right, so for the attendance exercise today, I just am asking what country plays the role of the swing producer in the OPEC model we talked about today. So which country, which Arabian Peninsula country is the swing producer in OPEC? And then, like I said, otherwise, I'm happy to hang out here. If it's useful, I can put you guys into your breakout rooms. Or if we just want to stay in the main room and I can answer questions as well, that's fine too. And I'll just type that, which country is the swing? So does anyone have any questions or preferences on whether you'd like me to, can we do breakout rooms? Yeah, I can, I will maybe stop the recording here and I will try to put you into breakout rooms. If I can put it there.